All right, let's talk about an investment that seems to promise everything we could ever want. But, there's always a catch. We're going to break down a fund that really taps into that constant battle in our minds, our desire for massive growth, and our need for a steady, reliable income. We're talking about GPIQ. I mean, it's the dream, isn't it? Getting in on the explosive growth of all the big tech names, while also getting a nice, fat income check month after month. This is the promise that pulls people into funds like GPIQ. It's so powerful because it feels like it solves that fundamental investor dilemma. But as you know, whenever something sounds that perfect, that's our cue to really start asking some tough questions.
So let's get right into it. The absolute best way to think about this fund is as a frenemy. Seriously. On one hand, it's your best friend, handing you that juicy, predictable income that helps you sleep at night. But on the other hand, its core DNA, that deep connection to really volatile tech stocks, can sometimes turn on you. It's like it gives with one hand and has the potential to take away with the other.
So what is this thing really? Well, GPIQ buys up all those big tech stocks in the NASDAQ 100. But here's the twist, and this is the important part. It doesn't just buy and hold. It also sells something called call options on those very same stocks. Now, think of it this way. It's like you're renting out a piece of your potential lottery ticket winnings. In exchange for giving up some of that explosive upside, you get paid guaranteed cash right here, right now. And that cash, that's the income it pays out to you. Okay. First up, let's look at the friend side of this frenemy relationship. That incredible promise of having your cake and eating it too. And now, for the other side of the coin, the enemy part. We're going to dive into something called concentration risk. And folks, this is where that shiny promise starts to show some serious cracks. And wow, when you look at this, what's just staggering is the sheer dominance of just a handful of companies. You see NVIDIA, Microsoft, Apple right there at the top. Together, they make up a massive slice of this entire fund. Let's be crystal clear about this. This is not a diversified investment in the traditional sense. Yeah, look at that number. Over half, more than 50% of the entire fund is packed into just its top 10 holdings. So when you buy GPIQ, you're not just making a bet on the tech sector. No, you are making a huge, concentrated bet that a small handful of mega companies will continue to crush it. And that kind of concentration, well, it brings very specific dangers. A bad earnings report from just one of these giants can tank the whole fund. And remember that renting out your upside we talked about? Well, that means when the market goes on one of those crazy explosive rallies, your gains are capped. Plus, the whole strategy is sensitive to stuff like interest rate changes. And that option strategy? Yeah, sometimes it can seriously backfire. This quote from some market analysis just hits the nail on the head. GPIQ is an aggressive play. It is not for the faint of heart. So that leads to a pretty obvious question, right? What in the world is the backup plan? So what is this backup plan? Well, in the world of finance, it has a name, hedging. And it's all about preparing for the worst while you're still hoping for the best. Honestly, the simplest way to get your head around hedging is to just think of it as insurance for your portfolio. It's that simple. You pay a small, known cost, kind of like a premium, to protect yourself from a much larger, potentially catastrophic loss. It's just like your car insurance. You hope you never have to use it, but man, are you glad it's there when you do. But, and you knew this was coming, right? That insurance isn't free. There's no free lunch in investing. On one hand, yes, you get protection. You get a much smoother ride, which is great for your nerves. But the cost is very real. You give up some of the potential gains in those huge market rallies. You have to pay the direct costs for the hedge itself. And, well, it just adds a layer of complexity. It's always a trade-off. Okay, so let's say you decide that trade-off is worth it. What does this insurance actually look like? What are the tools you can use? Let's open up the toolkit. You've basically got a few main options. First, you can buy put options. That's the most direct form of insurance against a drop, but they cost you money, and they can expire completely worthless if the market goes up instead. Or you could use inverse ETFs, which are designed to go up when the market goes down, but they can get really tricky to hold long term. And then there's the simplest hedge of all, good old-fashioned diversification. Adding things like bonds or utility stocks can act as a ballast when the tech stocks get hammered. Now, building a hedge is a deliberate process. It's not something you just wing. You have to start by defining your personal panic point, like how big of a drop can you actually stomach before you make a terrible emotional decision. Then you decide how much of your portfolio to hedge, you pick your tools, and this is crucial, you have to monitor and adjust it. A hedge is not a set it and forget it kind of thing. It's an active part of managing your money.
Okay, so we've covered the fund itself, the big risks, and the protection plan. Now for the most important question of all. How does any of this apply to you and your situation?
Let's try to make this simple. You should probably consider hedging if GPIQ makes up a really big chunk of your portfolio, or if you just know deep down that big market drops are going to cause you to lose sleep and make bad decisions. On the other hand, if this is just a small, speculative slice of an already well-diversified portfolio, you might be able to skip the extra cost and complexity of hedging. So what's the final verdict when you put it all together? Well, this combined strategy gives you that really unique hybrid of growth and income, and it absolutely cuts down on your downside risk. But the cons are real. It will almost certainly be a drag on your performance in strong bull markets, and it requires you to be an active manager. Plus, it has real costs. And that's really what it all boils down to, isn't it? It all comes down to this one single crucial question. It's the fundamental trade-off that every single one of us has to make as investors, that constant balancing act between greed and fear. There is no right answer. There's only the answer that's right for you.